investment opportunity. For sure, in different stages of the market, there would be better opportunities. Thinking back to 2009, but I think it's important to realize you have to take the opportunities as they're presented, and not based on what you wish for. And I think the investment's going to do very well for us. Stefan, feel free. Maybe one or two people could queue up at the microphone, then we don't have too long a pause before.
First of all, Rob, thank you very much for having us here. It's wonderful, and it's great to see how you are thriving after the small start that you had.
Thank you, Stefan.
I run a little investment firm in Hamburg, and we used to know each other when Rob was still a sell-side analyst. I have a question in relation to Trupanion.
Mm-hmm.
And Trupanion, they have this sort of target business model, which is roughly double the revenues they have right now.
Mm-hmm.
And if you take their business model and say they get there, that would be, I think, 13 times earnings or so.
Mm-hmm.
So I'm wondering, since that is a few years out, valuation on Trupanion, when does it make sense still? And the other point I want to ask, I guess if somebody comes into your fund new now, they buy the portfolio, I guess. How do you deal with the fact that some companies have gotten a lot more expensive than they were when you bought them?
Yeah, so two great sets of questions. So on Trupanion, it's primarily about valuation you wanted to talk about. What I see in Trupanion is a company which has a huge opportunity ahead of it. Trupanion sells medical insurance for pets in the US, and it's a very underpenetrated market there. So in the US, there's about 1% of pets which are insured, and in other countries such as the UK or Sweden, that number would be closer to 30%. And so that's the opportunity which lies ahead of them. And there's reasons historically why penetration has been much lower in the US. It was a much lower value product, the insurance one, and there were also some bad actors selling not particularly great policies, which rightly put people off. And of course, the amount of treatments that are available for pets now are much wider. So you can get hip replacements, chemotherapy, and whenever I tell that to people, there's always one or two reactions. There's some people who love their pets, and of course there's chemotherapy. And why wouldn't there be? And then there's other people who say, why wouldn't you just buy a new dog? And, I guess both views exist, and they don't need to win every single customer or every single pet owner, but the ones who do have a close relationship to their pet. And so with Trupanion, the opportunity is so large. I think that the real question from an investment perspective is it going to work or not? Because it's still a relatively young age, and there's things that work very well at the company. There's other things where they're still really trying to figure it out. So it's a much earlier stage. It's much more upside than probably any other investment in the fund, and much more risk as well, for that matter. And I was thinking about this when I made the investment in Facebook a few months ago. And of course, anyone who buys Facebook today is sort of banging their head against the wall of, why didn't I do this earlier? And as nice as it would have been to have bought Facebook 10 years ago, I'm not sure you would have slept as well with the investment, at least in a concentrated portfolio, as you would do today, because so much of the business model is still being figured out. And so, although we now know it's worked spectacularly well, there's no reason. There's alternative things that could have happened. And so I kind of view Trupanion as almost being like a kind of a company which is at a stage to where Facebook might have been if you'd invested 5 years ago. And I'm not sure I necessarily prefer the one to the other. I see the much greater upside on a company like Trupanion, but I have a lot more certainty about the investment of Facebook, and so it will be interesting for me to see how the two investments work out, and if Trupanion were to work out poorly, then for me that would be an indication that it makes sense to maybe wait for companies to be a little bit more mature in terms of their life cycle, even if that means the growth opportunity is a little bit lower. But if it does well, then maybe that's a sign that it is possible to identify these companies at maybe a slightly earlier stage than a Facebook is today. So I'm open-minded about how that works out, and we'll learn from whatever comes from it. And then the second part of your question was, we bought Trupanion over a year ago. The price was probably about half what it is today. But that's no use to someone who invests in the fund today. What we paid back then, they're going to effectively be buying a stake in Trupanion, and for that matter, all of the other companies at today's prices. And that's a question I've struggled a lot with, and I'm not sure I even today have the perfect answer for it. And it strikes me as such a difficult question. It amazes me that I don't see it being talked about more. And the way I manage money, so I had I think the fortune never to work at a traditional fund manager, so I don't know how they do things, and just do things from pretty much from first principles of what I would do with my own money. And the way I used to manage my own money when it was separate, and how I do now through the fund, is to just treat it like it's my own money. And when I buy something, I pay a lot of attention to all the types of things you would expect me to look at, such as the quality of the management, the business, and all that kind of stuff. But having built that confidence in the company, I don't then wake up every morning and question the decision. I kind of view that then as a long-term commitment to the people, and I for sure I'm gonna start trading in and out of stocks at quarter end based on new people coming into the fund or not. So that isn't ideal for new investors. So if I'm not going to start trading aggressively, what does that mean? I think it means two things. First of all, there's obviously advantages, huge advantages from investing with someone who's basically managing their own money next to yours. But it's not a perfect situation, and this is for sure one disadvantage there is there. So people need to weigh up the one against the other. The second point I think is, of course, the portfolio does sort of turn over time slowly, but it does turn over. So the longer you stay in the fund, the more you're kind of getting the Trupanions at $7 rather than $16. So I think it's definitely an argument for staying put for a long time. And the third thing, and this is I think probably the most important point, is I think I as a fund manager need to be much more kind of proactive about opportunistically opening and closing the fund depending on where valuations are. I think funds tend to get closed when the manager says I have enough money in the fund to live well, and all that kind of stuff. And that's clearly the wrong way to think about it. The fund should be closing when it's unattractive for the customers, not when it's unattractive for the manager. And so that's something I intend to do much more proactively going forward, and in fact have been doing with people who've asked me whether they should invest. What I've been saying is I think that now is not the right time, and there's going to be better opportunities, and I'd much rather take investors in when there's a little bit of panic in the air, because A, they're going to get a much cheaper price, which is great for them, but B, only a very particular type of investor is going to invest when there's panic in the air, and that's basically an investor that really understands Mr. Market and how he goes through his periods of depression and excitement and stuff. And those are the investors and partners that I want. And I think only being open when there's a little bit of panic in the air is a great way to get investors to self-select.